Major changes are being made to the banking system very quietly, and I believe most people are not prepared for what those changes mean. When people think about risk, they usually think about markets falling, a recession starting, inflation rising, or a war affecting the price of oil. Those risks are real, but there is another kind of risk that is usually more personal, more immediate, and more frustrating. It is the risk of not being able to use your own money when you need it. That is the risk I want you to understand. This is not about panic. It is not about conspiracy thinking. It is not about telling you that every bank is about to fail or that every government is coming for your account. That is not how I think. I think in terms of systems, incentives, rules, and probabilities. When a financial system becomes more leveraged, more monitored, more digitized, and more stressed, the rules around access to money change. They usually change slowly. They change through regulation. They change through bank compliance departments. They change through insurance limits, reporting rules, tax authority powers, dormancy laws, and emergency measures that most people never read. Then, when stress arrives, people are shocked to discover that the relationship they thought they had with their bank was not the relationship that legally existed. They thought their deposit was simply their money sitting in a safe place. But in the legal and financial system, it is more complicated than that. A deposit is also a liability of the bank. The bank owes it to you. The bank uses it inside a system that is regulated, monitored, and sometimes restricted by governments. And if a crisis happens, or if your account triggers the wrong kind of review, your ability to access that money can be very different from what you assumed. That is why many wealthy people are paying close attention to the banking rule changes taking place right now. They are not doing that because they are smarter as human beings. They are doing it because they understand that in a system, the rules matter more than emotions. The first thing to understand is the shift from bailouts to bail-ins for a long period of modern financial history. Many people assumed that if a large bank got into trouble, the government would step in and save it. That assumption became very strong after repeated crises. The public saw governments and central banks act as backstops. They saw rescue packages, they saw liquidity facilities, they saw emergency support. Then the 2008 financial crisis changed the political and regulatory incentives. Governments had to spend enormous sums to stabilize banks. Taxpayers were angry. Regulators understood that the old model created moral hazard. If banks believed they would always be rescued from outside, then the costs of failure were being shifted away from the institution and onto the public. So regulators began to build a different mechanism. Instead of only relying on a bailout from the outside, the system increasingly allows for a bail-in from the inside. That means that when a bank becomes insolvent or faces severe losses, regulators can use certain parts of the bank's own capital structure to absorb those losses and stabilize the institution. In principle, the order is supposed to be rational. Shareholders take the first hit. Then certain debt holders and bondholders take losses. Then, if the losses are severe enough, large uninsured depositors can be affected. This is where most ordinary people miss the key point. Deposit insurance is limited in the United States. The standard limit is $250,000. In the European Union, the common level is 100,000 euros. In the United Kingdom, the limit is 85,000 pounds. In Canada, it is 100,000 Canadian dollars. Those numbers sound large until you look at the way real lives work. A business owner can have payroll cash above those limits. A retiree can sell a house and temporarily hold the proceeds in a bank account. A family can receive an inheritance. A person can be waiting to buy another property, pay taxes, or settle an estate. The money above the insured limit may feel like cash in your account. But legally, in a banking crisis, it can become unsecured exposure to the bank. This does not mean every uninsured deposit will be taken. It does not mean every bank failure will produce a bail. And what it means is that the risk exists inside the rulebook, and intelligent people do not ignore risks simply because they are low probability. They ask what the consequences would be if the risk materialized. That is how I think about it. A low probability event that can destroy your liquidity deserves attention. A low probability event that can trap the cash you need to pay employees, buy a home, cover medical costs, or protect your family deserves planning. The second thing to understand is that the risk is not only bank failure. Many people assume that their account is safe as long as the bank is safe. But modern banking risk can arise even when the bank itself is not failing. One example is the dormant account problem. In many countries, if a bank account sits inactive for a certain period of time, it can be classified as dormant. Once that happens, unclaimed property or escheatment laws can allow the assets to be transferred to the state. There is usually a process to reclaim those funds, but anyone who has dealt with a bureaucracy knows that a right on paper and quick access in real life are not the same thing. The real issue is not merely that dormancy laws exist. The issue is that the definition of dormancy has been moving in a direction that gives people less time and broader exposure. Some jurisdictions have shortened dormancy periods. Australia reduced dormancy periods for many financial assets from 7 years to 3 years. In the United Kingdom, the dormant asset scheme has expanded beyond bank accounts to include other assets, including investments and insurance balances. In the European Union, policymakers have discussed harmonizing dormancy laws across member states, which could bring different systems toward a lower common threshold. This is the kind of thing that rarely makes emotional headlines because it sounds technical. But technical rules are often where financial freedom is either protected or lost. If you have an account that you rarely use, an old account in another state, a small investment balance, an insurance balance, or an inherited account that has not been actively managed, the system may not see that as careful preservation, it may see it as inactivity. And once the system labels the asset a certain way, the process is no longer controlled by your intent. It is controlled by the rule. That is a principle worth remembering. Your intent does not matter very much to an automated or bureaucratic system. The record matters, the activity matters, the classification matters. That is why some wealthy families prefer jurisdictions where the legal tradition strongly protects asset ownership and where banks have a much longer obligation to locate the owner or heirs. Before assets are transferred away, the specific countries can vary. The bigger principle does not. You do not want all of your liquidity sitting inside one rule system if that rule system can reclassify your money because of inactivity, compliance concerns, or local administrative pressure. The next issue is civil asset forfeiture. This is one of the most misunderstood risks in modern financial life. Most people believe that assets can only be taken after a criminal conviction. They believe the sequence is simple. First, someone is charged, then someone is convicted. Then the government can take property connected to the crime. But in many developed countries, there are legal mechanisms that allow authorities to freeze or seize assets without a criminal conviction. In the United States, civil asset forfeiture exists under federal and state law. In the United Kingdom, authorities can use unexplained wealth orders. Australia and Canada have similar systems connected to proceeds of crime enforcement. The intention behind these systems was to target organized crime, corruption, money laundering, and other serious misconduct. I understand why governments want tools to address those problems, but every rule has both an intended use and a possible overuse. When the legal threshold for freezing assets can occur before a case is fully resolved, the account holder may lose access to money long before guilt or innocence is established in any final way. That matters because liquidity is life. If your account is frozen for months or years, the legal theory may be one thing. The practical experience is another. You may still need to pay lawyers, you may still need to pay taxes, you may still need to support a family, you may still need to operate a business, you may still need to handle medical bills or emergency costs. A frozen account can create damage even if the matter is eventually resolved. This is how systems often work. The punishment is not always the final judgment. Sometimes the punishment is the process. That does not mean a person should run away from legal systems or avoid lawful obligations. It means a person should build resilience before a problem appears. When I study any system, I ask where the single points of failure are. If all your liquid wealth is in one bank, in one country, in one currency, under one legal regime, and accessible through one set of rules, then you have concentration risk. Most people understand concentration risk in investing. They understand that owning one stock can be dangerous, but they often fail to understand concentration risk in banking. Then there is the problem of capital controls. This is one of the clearest examples of a rule that people think only happens somewhere else until it happens where they live. Capital controls are restrictions on moving money. They can limit withdrawals. They can restrict international transfers. They can block foreign currency conversion. They can trap funds inside a domestic banking system or inside a domestic currency. When capital controls happen, your money may still technically exist. That is the part that confuses people. They look at the account and say, the number is still there. But if you cannot withdraw it freely, cannot transfer it freely, cannot convert it freely, and cannot move it to where it is needed, then the usefulness of that money has changed. A number that cannot move is not the same as liquid capital. People often believe capital controls are only a developing market problem. History says otherwise. During the Cyprus banking crisis in 2013, withdrawal limits and transfer restrictions were imposed. During the Greek debt crisis, ATM withdrawals were capped after Iceland's banking collapse. Strict capital controls lasted for years. These were not imaginary economies. These were not ancient examples. These were modern systems under stress. The principle is simple. When governments and banking systems face severe stress, they often prioritize system stability over individual flexibility. That may be rational from the standpoint of the state, but it can be very painful from the standpoint of the individual. If you are holding all your money inside a country before capital controls are imposed, you are usually too late once they arrive. The way to reduce that risk is not to panic during the crisis. It is to have some diversification before the crisis. That is how good risk management works. You prepare before you need the preparation. Another change has less to do with a banking crisis and more to do with what you are allowed to do with your own capital. Governments are increasingly shaping what people can own, how they can own it, and how difficult it is to hold certain assets. This shows up through investment restrictions, reporting requirements, tax complexity, caps, and rules around certain asset classes in the United States. Foreign mutual funds can create complicated tax problems for American investors. In the United Kingdom, there have been discussions and proposals around limiting stablecoin exposure around the world. Regulators are increasing scrutiny of crypto holdings, foreign currency accounts, and gold transactions through reporting systems and anti-money laundering rules. These policies are usually justified under the language of financial stability, consumer protection, anti-money laundering enforcement, or tax compliance. Sometimes those justifications are valid, but from the perspective of the individual, the effect is still important. The rules shape what you can do with your capital. They can make certain choices expensive. They can make other choices bureaucratically difficult. They can make diversification harder for ordinary people than for institutions. That is a pattern I pay attention to. When rules make flexibility harder, flexibility becomes more valuable. When access becomes more restricted, having access before the restriction becomes more valuable. When the system pushes people toward one approved path, the people who understand alternative lawful paths often have a structural advantage. This is not about avoiding rules. It is about understanding them before they are applied to you. The next risk is currency debasement and the possible future of central bank digital currencies. Currency debasement is not complicated. It happens when the money supply expands faster than the real economy and the purchasing power of money declines over time. If inflation is higher than the interest rate you earn on deposits, your savings may look stable in nominal terms while shrinking in real terms. That is one of the quietest forms of wealth transfer. Your account balance can remain the same, but what it buys can fall. Many people do not react strongly to this because the number on the screen has not gone down. But intelligent investors think in real terms, not nominal terms. The question is not how many currency units you have. The question is how much purchasing power you control. At the same time, many central banks have explored central bank digital currencies. The specific design and use of CBDCs are still debated. It would be wrong to say that every scary possibility will happen, but it would also be naive to ignore what the technology could allow. A digital currency issued directly by a central bank could, depending on how it is designed, allow new monetary tools that are not possible in the same way with physical cash, programmable money. Spending restrictions, targeted stimulus, demographic-based policy, negative interest rates, more direct visibility into transactions. Again, the point is not to say that all of this will happen. The point is to understand the direction of the system. Money is becoming more digital, banking is becoming more monitored, compliance is becoming more automated, governments are becoming more interested in real-time financial data. When those trends combine, individual financial privacy and flexibility can decline unless people deliberately protect them within the law. Another issue is tax authority power. Every developed country has legal mechanisms that allow tax agencies to freeze bank accounts, generally for unpaid taxes or serious disputes. Through international agreements, information exchange systems, and tax compliance frameworks such as FATCA, authorities can gather information about accounts across borders. It is important to be clear about the principle here. This is not about tax evasion. Paying taxes lawfully and filing correctly is essential. The best protection is always clean behavior, proper documentation, and professional advice. But even people who pay their taxes and file properly can be concerned about aggressive enforcement, especially when accounts may be frozen during an investigation before the person has had a full chance to explain the facts. That is the difference between being guilty and being temporarily trapped inside a process. The system may eventually get it right, but if your money is frozen while the system is deciding, you still have a problem. Some jurisdictions require more robust domestic court proceedings before foreign tax claims are enforced. Others require specific treaty provisions and stronger documented evidence before accepting a claim. The practical point is not that any country makes you immune from lawful obligations. No serious person should think that the practical point is that legal process, standards of proof, and institutional culture differ. Those differences matter. Then there is transaction monitoring. This is something almost everyone has experienced in some form, whether they realized it or not. Modern banks operate under anti-money laundering rules that require them to monitor account activity. In the United States, suspicious activity reports are part of this system. Canada reports through FinTrack. Australia has AUSTRAC. The United Kingdom and European Union have their own frameworks. Many people think the only thing that matters is whether a transaction crosses a formal threshold such as $10,000. That is not true. Transactions below formal reporting thresholds can still trigger monitoring if the pattern looks unusual, if the destination looks risky, if the behavior differs from your historical profile, or if the bank's systems decide the activity requires review. What is changing is the speed, sophistication, and scope of monitoring. Banks are using behavioral assessments. They are using artificial intelligence. They are sharing more information. Compliance systems are becoming faster, more automated, and more interconnected. That can help catch real crime, but it can also create false positives. If a person sends a large wire, moves money abroad, withdraws cash, receives unusual payments, or uses accounts in a way that does not fit the bank's model, the bank may decide to review the activity. During that review, funds can be delayed or frozen. In some cases, the review may take a long time even when there has been no wrongdoing. This is one of the reasons wealthy people often prefer banks that are accustomed to large transactions, international activity, and complex profiles. A bank that mostly serves ordinary retail customers may see a large international transfer as unusual. A bank that serves global clients may see the same transfer as normal, provided the documentation is clean. The same action can be treated differently depending on the institution, the jurisdiction, and the profile the client established in advance. That is a powerful lesson. Do not wait until you need a bank to understand you. Build the relationship before the unusual transaction happens. Another risk is that information inside the financial system is no longer as isolated as many people imagine. As banking systems become more connected, the information that one institution gathers can influence how another institution views you. Risk scoring, compliance flags, payment network data, tax information exchange, and cross-border reporting all contribute to a more integrated financial surveillance environment. That does not mean every piece of information is shared with everyone. It means the system is moving toward greater visibility and less isolation. In the past, a banking relationship could be relatively local. Your bank knew you, your town, your business, your family, and your habits. Now, the system increasingly knows patterns, categories, risk profiles, and data points. That is a different relationship. A human relationship can understand context. A data system often sees deviation. This matters because many legitimate financial actions involve deviation. Selling a business, buying property, receiving an inheritance, paying for medical care, helping a family member, moving countries, changing investments, retiring, downsizing, starting a small business after retirement. These are normal life events. But to a monitoring system, they can look like unusual account behavior. That is why documentation and communication are so important. Then there is de-risking. Banks sometimes close accounts not because the client has done anything illegal, but because the bank decides the client profile creates too much compliance risk. This is called de-risking. It can happen to people who send large international transfers. It can happen to people connected to certain countries. It can happen to cryptocurrency, related businesses. It can happen to politically exposed persons. It can happen to clients whose activity is lawful but complicated. From the bank's perspective, this can be rational. Banks are heavily regulated. Compliance failures can be expensive if a client requires too much review or creates uncertainty. The easiest answer for the bank may be to close the account rather than investigate deeply. From the client's perspective, it can feel irrational and unfair. The account is closed, sometimes with little explanation, and the person must quickly find another institution willing to accept the relationship. This is another example of incentives. A bank is often rewarded for avoiding risk. It is rarely rewarded for understanding a complicated customer. Therefore, if your financial life is more complex than average, you must choose institutions that match your profile. Do not try to force a complex life into a simple banking model. That creates fragility. The final issue is the restriction of physical cash. This is most visible in parts of Europe where aggressive restrictions on cash payments have been rolled out in countries such as France, Spain, Greece, and the Netherlands. But the cash issue is broader than the law. Even where cash is still legal, banks, merchants, and payment processors can make it harder to use. Branches close. ATM access declines. Cash handling becomes expensive. Businesses stop accepting it. Large cash payments become suspect. The result is that people can lose practical freedom before they lose legal freedom. A right that cannot easily be exercised becomes weaker in reality. Physical cash is not perfect. It can be lost, stolen, or misused. It is inconvenient for large transactions, but it also provides a form of privacy, resilience, and independence from digital systems. When societies move away from cash, they gain efficiency. They may also lose optionality. That trade-off should be understood. Honestly, the common thread through all of these changes is not that every bank is unsafe or that every government action is malicious. The common thread is that the modern financial system is becoming more controlled, more monitored, more digital, more rule-driven, and more fragile for people who assume the old rules still apply. In a world like that, the wrong response is panic. Panic makes people impulsive. Impulsive people make bad decisions. They move money for emotional reasons. They buy things they do not understand. They fall for schemes. They confuse fear with prudence. The right response is not panic. The right response is thoughtful diversification and preparation. That means understanding your deposit insurance limits. It means not holding unnecessary uninsured balances in a single bank. It means keeping accounts active so they cannot be mistaken for abandoned property. It means keeping clean documentation for significant transactions. It means understanding the difference between legal tax planning and illegal tax evasion. It means using institutions that understand your actual financial profile. It means having more than one banking relationship if your assets justify it. It means thinking about jurisdictional diversification, not as a way to escape responsibilities, but as a way to reduce single country, single bank, single currency risk. And above all, it means recognizing that money is only useful when it is accessible, lawful, documented, and resilient. I have learned over many cycles that the people who do best are not the people who predict everything perfectly. No one can do that. The people who do best are the ones who understand the system well enough to survive when the system behaves badly. They know that rules change. They know that incentives matter. They know that stress reveals weaknesses. They know that concentration creates vulnerability. They know that liquidity is most valuable exactly when everyone else is losing it. So when I look at these banking changes, I do not see one isolated rule. I see a pattern. I see a shift from taxpayer bailouts toward internal loss absorption. I see dormant asset rules that can move unused funds into government hands faster than many people expect. I see civil forfeiture systems that can freeze or seize assets before final conviction. I see capital controls as a tool that developed countries have already used under stress. I see asset restrictions and reporting rules shaping what people can own. I see currency debasement quietly reducing purchasing power. I see central banks exploring digital money that could make policy more direct and money more programmable. I see tax authorities becoming more coordinated across borders. I see transaction monitoring becoming more automated. I see information sharing expanding. I see banks de-risking clients who do not fit simple models, and I see physical cash becoming harder to use in many places. Each of these things on its own can be explained as a response to a real problem together. They form a direction, and when a system moves in a direction, intelligent people adapt before the direction becomes painful. That is the main message. You do not have to be afraid, but you do have to be awake. You do not have to believe the worst-case scenario will happen. But you do have to respect the possibility that rules can change faster than your habits. You do not have to abandon your home country, your bank, or your normal financial life. But you do have to understand that a good financial life in the modern world requires more than saving money. It requires protecting access to money. It requires protecting the mobility of money. It requires protecting the purchasing power of money. It requires protecting the legal clarity around money. That is the real banking lesson for 2026 and beyond. Most people will wait until a problem forces them to learn it. They will wait until a transfer is blocked, An account is frozen, a bank fails, a dormant account becomes bureaucratic, a tax notice arrives, a wire is delayed, or a new rule limits something they used to do freely. Then they will try to solve the problem under pressure. That is the worst time to solve it. Pressure narrows the mind, preparation expands options. So look at your money the way a good risk manager looks at a portfolio. Where is it concentrated? Where are the single points of failure? Which accounts are uninsured above the limit? Which accounts are inactive? Which transactions would be hard to explain if reviewed 2 years from now? Which banks actually understand your profile? Which jurisdiction controls your access? Which assets are liquid only in normal times, but less liquid under stress? Which habits came from an old banking world that no longer exists? Those are the questions that matter. The people who ask them now will not be surprised later. And in financial history, not being surprised is an enormous advantage, because the goal is not to predict every rule change. The goal is to build a life and a balance sheet that can handle rule changes. That is how I would think about the new banking rules. Not emotionally, not politically, not fearfully, systematically. The system is changing. The incentives are changing. The monitoring is changing. The access rules are changing. And when the rules around money change, the people who understand them early are the people who keep the most freedom. That is the point, not fear. Freedom through understanding, freedom through structure, freedom through preparation, freedom through diversification, freedom through having your money positioned so that one bank, one country, one compliance department, one dormant account rule, one capital control, one digital payment system, or one legal process cannot determine your entire financial life. That is what wealthy families have understood for a long time, and that is what ordinary people need to understand. Now, because the modern banking system does not care how hard you worked for your money, it cares whether your money fits the rules. So your job is not to complain that the rules are changing. Your job is to know them, respect them, document your behavior, diversify your access, and protect yourself before the moment comes when access matters most. That is how you stay calm when other people panic. That is how you make better decisions when systems are under stress. And that is how you make sure that the money you spent your life building remains useful, accessible, and protected in a world where the rules are no longer as simple as they used to be.